Episode 1 of The Wealth Show with Equity Kings. Welcome to The Wealth Show with Equity Kings. My name is Dumisho Ramudisa and I'm accompanied by my co-host Siyabonga Chuma, my business partner. And let's just get into it. So Sia, welcome man, welcome. How have you been doing, man?
Thanks for having me on the show. I've been better. Could have better days, but nonetheless, thanks for having me on the show, and I hope to the listeners you will take something out of this episode. This is officially episode 1 of the Wealth Show, and welcome to our community. We hope we will grow together and learn from each other. With that being said, I think let's jump right into it and not waste any more time. Dumisho, can you please set the tone for us and just set the base for us of what we're going to be touching base on for today?
Yeah. So guys, I'll be talking about the dollar and oil because I think it's something very key that we should all follow. And I've been following the oil market. I'm not an expert in the oil market. Let me just say that, just for a disclaimer. I'm not an expert in oil, but I have been following one of my favorite pioneers in the oil industry, Art Berman, and He's been really bullish on oil. Last year 2020, he was bullish on oil. He said that oil could get past $65 a barrel, which it did by December 2020. So his prediction was right there. I predicted on my stories, on my Instagram stories, on Twitter, everywhere, those who chat with me on WhatsApp, every single social media platform, and I predicted that oil could hit 100. A wild prediction, Sia, that oil could hit 100 by end of 2021. $100 a barrel. Yeah.
And imagining it that last year, 2020, April, oil was at it got to $7 a barrel, if I'm not mistaken, on the crash. Around there, I think it did get to 7. I think that was around its lowest point. But imagining from 7 all the way up to $30 a barrel, and we were still in lockdown.
Imagine
that does raise a lot of questions.
I mean, it does. It raises a lot of eyebrows because imagine, obviously we knew that oil was going to crash when they locked down the economy in end of March. So oil did crash. As Sia said, it crashed to around $7 a barrel, $8. I'm talking about WTI crude oil. But if you look at the futures market of oil, that thing went to negative 40. Of course, people were asking, does it mean we're gonna pay negative prices for oil? Does it mean that they're gonna give us oil for free? No, that's not what it meant. It was just the futures market. So it's just the future value that the market thought oil would be, which was negative 40, and then obviously it rebounded. So why did it rebound in the first place? It rebounded obviously because of the fiscal expenditure and all these government interventions and all these goodies that people like. But the problem is, as you all know, these things have consequences, they have unintended consequences. And look what's happening with oil. Now oil is near pre-COVID levels, or pre-pandemic levels rather. I think right now it's trading around $63 a barrel, if I'm not mistaken, at the market close on Friday. Friday was the 24th, I'm not sure. It's the 24th of April. Yes, so that's where it was trading. It was trading around $63 a barrel. And I think there's still more bullish momentum for oil. If you ask me, I'm bullish on oil. I mean, I'm in Sasol. I have a position in Sasol. Yeah, oil to the moon. Sia, what's your take on oil?
Oil to the moon, indeed. Oil to the moon. But oil is a very good commodity.
Yeah.
A lot of countries need it. It has a lot of needs. So hence, one can argue, is it a good hedge against inflation? And now let me explain the term hedge against inflation to those who are not familiar with investing words. So hedge against inflation means, okay, here you are 25 years old, you've just got your job, you're working, and obviously you want to take a certain percentage of your salary towards your retirement savings. Okay, now you gotta know inflation happens whether you like it or not. 2.4% at most, or 2%, but inflation does take place yearly, even depending on how the government handles its financial economy, interest rates, employment rates. Those are the other factors for inflation. So with that being said, what you want as a 25-year-old, what you actually want to do is take the money that you were just going to save without it compounding or whatever. Take the money and look for a lucrative stock. I mean, if we can look at past data for S&P 500 for the last 10 years, it gives out a return of 6.8 on average. Okay, so Dow Jones could be one of your investment assets to hedge against inflation. So hedging against inflation means your money is kept within time, but you got to understand there is risk involved. And the risk is, what if 1 year is left for you to go into retirement? Okay, now you want to cash out your money, now you want to go retire. There's 1 year left, you're waiting, it's your last year. And then what happens? Boom. I'm going to make an example with the 2008 financial crash. So 2007 summer, you're thinking, okay, 2009, I'm going to retire. 2008 is my last year. And on your last year, let's say you've been saving 50% of your salary bracket, investing it into that asset for the past 20 or 30 years rather, okay, because you looked at this long term. And now only left 1 year left for you to retire. And what happens is the 2008 financial crash catches with you, because there are some people who it actually caught them. I mean, the data is very possible and most likely. Now, we are talking now about what could happen in the future. But let's say you did that. Now, 1 year left for you to cash out and the market crashes. How will you feel? How will you feel? What are the emotions will you have? And let's say your family advised you to get out. They were like, just get out and then keep the money with you before you retire a year before. But then your emotions of greed were like, I've waited 20 years. What's 1 year going to do? And you find that the crash happened, then it wipes out 60% of your portfolio investment. Now, those are the risks of hedging against inflation. So hedging against inflation necessarily means saving your money so that it accumulates interest, compound interest rather. So,
but Sia,
would you say?
Think about this. Just to go back to your point on the Dow Jones, you mentioned since it gives a certain return, if like an average annual return, I think you said 6.8, or did you say 6? Around that percentage. So yeah, I will argue that even though it's better than having your money in a bank account and let inflation erode all your savings, I don't think it can be better, but I don't think it can be an inflation hedge, because to me, my definition of it is something that tracks inflation, not necessarily not to say that it necessarily has to beat inflation, but when inflation goes up, it goes up with it. Dow Jones, the stock market, doesn't just go up and down with inflation. It goes wherever it wants to go. So with me, I look at things like think anything can be an inflation hedge that's a consumer good, or yes, a consumer good like coffee, these commodities. You can see things like gold. Those are inflation hedges, because obviously when inflation basically means anything, the prices are rising for this certain thing. So if you look at consumer prices, if consumer prices are going up as a result of consumer price inflation, then obviously it means that goods and services are increasing. So if you own a good that can store properly, like gold or silver, that is an inflation hedge, because it's going up with inflation. And if there was deflation, that would be a different story, because if it was deflation, then that commodity would actually be going down. So you don't know what happens with the stock market. I don't think it's an accurate way to say it's a measure of inflation, or it's an inflation hedge or store of value. Yeah.
Listen, let me rectify. I'm not rectifying myself. I'm maybe making things a bit clearer for you.
Yeah.
The example was explaining how to invest for your savings retirement and what is the term hedge against inflation. Now, as an investor, we've got different portfolios of different assets we can look to into investing. Now, it depends on what you prefer. What type of risk are you on? Now, you cannot dispute that S&P 500 over a period of a decade can give you that amount of returns. So what my point was is that you should look at it as something that can give you returns. You can get some sort of return. That's how you're looking at it. Now, what you're trying to argue with me about is that gold and silver are more lucrative than S&P 500. That could be true. I do not have the stat, but I was just making an example to the listener, and I hope they got the example.
Okay.
Now,
No problem.
we could argue which asset is better to hedge against inflation, which asset has less risk, which asset has more returns, which asset grows faster, I mean, look at the age we're in now. I feel like the age we're living in is an unprecedented financial age because of the things that are happening. Like, guys, can I firstly ask, where are these coins coming from? I mean, I do not know a lot of coins, but 2021, I've realized some new coins. And looks like coins are being a threat to the government of some sort. And as we are talking now, our Bitcoin gains have been wiped out for the first quarter of the year. And people like Elon Musk are buying into Bitcoin. And there's the recent one that I've just heard about. I do not have a lot of intel, but it's Dogecoin. What are the stats there for Dogecoin? If you have them, Dumisho, can you just share them with the listeners?
Yeah. So Dogecoin. Just to clear Dogecoin, it was actually invented to be a joke, to joke about cryptocurrency. The irony here, it was initially supposed to be a joke, and then it turned out not to be a joke because Elon Musk and all these guys were pumping Dogecoin. So I think for this year, if you look at the statistics for this year, since 2021, Dogecoin has outperformed almost all cryptocurrencies. Bitcoin rose about 800% for the past year. Dogecoin rose about 5,000%. 5,000% increase in a year. 5,000, that is unprecedented. As you said, Sia, we're living in an unprecedented time. So I'm not saying this to say Dogecoin is the best or anything, but this takes me back to these guys who always criticize me because I think I'm one of the biggest Bitcoin critics. So these Bitcoin critics, I was saying that gold is an inflation hedge, and people were saying, no, Dumisha, no, Bitcoin is the new store of value. It's a new inflation hedge. So that argument didn't make sense to me. So I kept on saying, why do you think Bitcoin is better than gold? Oh, because it outperformed gold, and gold hasn't even been performing that well. So I asked, so if that's the case, if your reasoning behind Bitcoin being better than gold is that it outperformed gold, then you must also concede that Dogecoin is better than Bitcoin because Dogecoin outperformed Bitcoin. So that's the irony here, man. What do you think about Bitcoin? And I know you're a big fan of Bitcoin. Not trying to put words in your mouth, but I know you're a big fan of Bitcoin, so you might as well just chop my head off for saying that.
This issue is very controversial to start off with. Firstly, we could argue it's a bubble.
Yeah, for sure it is.
We could argue it's a bubble. People are just excited. It might crash. The bubble might continue. But I was listening to Peter Schiff the other day, and it was like the market is unjust. And he made an example with Tesla. He's like, when investors looked at Tesla's balance sheets, the actual Tesla as a company, when they looked at it and how it's performing, they could argue it wasn't doing that well compared to the price on the stocks market, or the Tesla price. Okay. So what happens is there are a lot of people who are selling Tesla along the way, and you couldn't say they were wrong. They looked at the facts. But now you could have the facts and the time and the money. But here's where it comes in. Elon Musk has got a lot of liquidity. He pumped a lot of liquidity into his stock, and a lot of people pump liquidity. So we have, Peter Schiff said, we had a lot of people who are shorting the stock along the way, shorting, and they eventually gave up because they ran out of margin. Because this thing just kept on growing exponentially.
Much balls.
Yeah. So as you can see, it's a new trading environment. I think we're in a new trading environment now. We can't really argue about that. We're in a trading environment. You might find that 10 years from now, what Dogecoin just did is like, fuck, that's nothing. Or it could be vice versa. But with the times that we are living in, I feel like, as you say, Dogecoin started as a joke. What could be the next joke? It could be a domino effect.
Yeah, I mean, here's the biggest. Let me tell you what's the next joke. The next joke is the markets crashing, the crypto market bubble finally popping. Because this whole crypto, what can I say, frenzy or hype, it's just the same. If you can recall, we weren't born at this time. So we're still young, guys. We weren't born at this time. But for those who remember the dot-com bubble of the late 90s, the late 1990s, think it popped in 2000, when the bubble popped in 2000 or 2001. This bubble,
another term is the flash crash. .com or the flash crash.
Exactly. You see this dot-com bubble, it reminds me of cryptocurrency. And there was this other company. This is how most people saw that the dot-com bubble was gonna pop. This company, which was a huge dot-com company, when its IPO came out. The IPO is basically when a company goes public into the stock market. So that's an IPO. So when this IPO came out, I think it was Warner came out, and when it did come out, people were hyping it. CNBC, all these news outlets were hyping the stock. And then a few months later, it crashed and it took the whole market with it. Same thing as, this could be the same thing. I'm not saying it would be, but this could be the same thing as Coinbase. Because Coinbase IPO just got released last week. If I'm not mistaken, it was last week, Wednesday. And this could be another Time Warner. It could be another Time Warner, just in 2021 in this crypto space. So I see this crypto bubble popping. I just don't know when, because obviously it just needs people to pump the price up. It has no real intrinsic value. I'm not saying the whole crypto space doesn't have intrinsic value. I'm just saying these ones that are in bubbles have no intrinsic value. So it just needs people to keep pumping the price up. It's just like a pyramid scheme. You have to get someone to buy. You need to get a greater fool to buy it at a higher price until you run out of fools, and then there's no buyer. When you want to sell your crypto, there's no buyer, and then the whole thing pops. And when it pops, you'll be left holding the bag because there's no buyer. Because you can't just sell in the market. For every buyer, there's a seller. So when you sell your crypto, someone has to buy it. That's just like a stock. When you buy groceries, if you want to sell your groceries, someone has to buy it. So if there's no buyers, the whole thing pops. It collapses. And that's what's going to happen. The whole Ponzi scheme is going to collapse. Not saying it's a Ponzi scheme. Crypto is legit. I'm just saying the bubble itself is operating just like a Ponzi scheme. That's what I'm saying.
Yeah, and if you look at it, another example with the flash crash, what happened is Yahoo depreciated in its value. And then I'm not sure, between Google and Microsoft, one of the two companies wanted to buy Yahoo. I'm not sure of the amount, but it was good amount of dollars they wanted to buy Yahoo. And then Yahoo said no. And the stock depreciated like Yahoo's worthless, to be frank.
I thought it was gonna be zero.
Yeah. But then it comes to this as human nature. Would we say history usually repeats itself based on our behavior? Or is it luck? Is it fate? Because those things do play a role sometimes.
Yeah.
I mean, Dumisha, give me other examples of companies that Google wanted to buy out. For example, with Blockbusters, I think Netflix wanted to buy Blockbusters, right?
Yeah, that's true.
Yeah, Netflix wanted to buy Blockbusters. Blockbusters says no, we're the hottest boy on the block selling CDs. And little did you know that we were gonna evolve into online entertainment because it's more convenient. I don't have to return anything. There are no penalties. It's just at home. How convenient is that? So you have situations where you have company owners, they approach with a deal. They have an option to say yes or no. And whatever unfolds in the future, I don't think it's really up to them. Luck does play a role. IQ does play a role also. But that's just fate. Okay? So we've made examples with the 2020 COVID crash. I'm pretty sure everyone is familiar with that. Now, and then the .com bubble. Now, let's just take a few steps back in between, and then we're going to jump to also one of the most known phenomenal crash, the 1921 crash. So now we're going to dive into the consequences of the 2008 crash, and then we're going to outline what are the human behaviors that we can pick up out of all these situations. First of all, it's fear, it's greed, and it's bubbles popping.
This podcast episode is proudly sponsored by Libertex, arguably one of the biggest forex brokers of the 21st century. Libertex has a wide variety of financial instruments to trade with, from currency pairs, stocks, energies, and even a broader variety of commodities to trade. I personally use Libertex, and the one thing I love the most about this broker is their incredibly low spreads. Libertex has been operating since 1997 and has won over 30 prestigious awards worldwide, and is even a sponsor for Tottenham Hotspurs. So click the link in the description to sign up and enjoy the perks that come with trading with a world-class broker.
The 2008 crash. I was still young by then, guys. I think I was in grade 1. Yeah, I didn't really know a lot about the financial markets. I actually even had no idea. But I do remember this instance where there was a neighbor who sold their house during 2008, and then some dude bought it. So now when I reanalyze that situation, I'm like, oh, the French guy sold the house because the housing market was low, and plus he was in South Africa, and I was like, whoa, the economy here is bad. So he sold the house for what he could get at that point, but I'm sure the bubble had popped. And then the guy bought the house cheap, I'm sure, and now I'm sure the house is appreciated in value. So anyways, guys, the 2008 financial crash. You see, that crash draws down to one emotion: greed. Greed. So it was primarily caused by deregulation of the financial industry that permitted banks and hedge funds to trade with derivatives. So just go Google what derivatives are. To be sure, we're not going to tell people what derivatives are. They can Google that. So in a nutshell, we don't want to give all these fancy terms yet. So what we're going to do, we're going to tell you what happened in a nutshell, in a summarized diagram. So here's what happens. The housing market is booming in the United States. The housing market is booming. Interest rates, why it's a negative, right, Dumisho? Let's walk together.
I think they were at 0 at the time during the early 2000s. Yeah.
Okay. Interest rates were at 0. So compared to where they were, it was easier to go to the bank and borrow a loan to finance your house, your business, okay? So particularly, there's this fascinating story, personally, that I'd like to make an example with. The Lehman Brothers and AIG, which is a broker company. Well, AIG is still alive and kicking today. Don't know how they made it out, but they did. So Lehman Brothers, just research about them. They're an investment bank in the United States. So Lehman was one of the biggest investment banks in the United States.
Yeah.
It gave out loans to houses so you could get your mortgage at low interest rates. So what happened there, guys, is that eventually there was no demand for houses. The bubble bursted because there was a lot of supply for houses. Okay, there was a lot of demand and the supply was there for houses. And then, as you know, the trend is bound to break because now everyone has houses and everyone is paying back. So here's where they went wrong. Usually you're supposed to have a credit score so that the bank can approve your loan, your mortgage, or whatever the source for the loan is for. So greed got into the people, and people like Lehman Brothers, they decided, oh, you want a house, come here, buddy. They didn't do a financial track record to see how long have you been working in a certain job, what is your financial status, what are the assets you own. It was everyone gets a house, Wolf of Wall Street, everyone gets a house, the house is on the house. It was something like that. Now, comes time to pay, some people are unable to pay. Okay? And there goes the bubble burst. People are not able to pay for their houses, now the bubble burst. Now having a house in certain neighborhood is worthless. But then there's also a controversial issue on that, but we'll not touch on that. But I'd like you to keep in mind, we're going to talk about it in a separate episode of how also people of color affected the housing market in the United States. But anyways, for now, what we'll carry on about is that the housing market bursted. The 2000 crash was actually the main reason because of the financial crash of the housing market. So when you look at it, you had companies like AIG, which, if I'm not mistaken, it's from the UK or United States. Between those two countries, I don't have
biggest company in the world.
Yeah. So essentially, what AIG is a broker. Okay. So for those who don't know what a broker is it's a company, but we could say it's a person who can go into the market and be like, okay, this orange is 5 rand. I've got access to the orange is 5 rand. And goes back to you as the willing buyer and is like, the orange is 5 rand at the market, but I'm willing to give it to you at 7 rand. So I keep 2 rand commission. So even with the real estate, selling houses, yeah, your companies Pump Golding, Remax, that's where they make their money from. So essentially, you want to sell a house, you contact them, they are the broker. Remax, 24/7, Louis Giffen, those are the South African companies that I know of real estate that I can mention at the moment. So what happens is you call them, you're like, yo, look, I want to sell my house. They're like, oh, okay, they come, they evaluate your house, your area, they check the houses around the area, what's the going price, and then they come up with a good price. They do the math, cool. And they put the house on the market. So let's say your house is worth $1 million. They might put it for 1.2 million, and then they take that extra 2% or whatever the percentage, but let's say 2% for this. They take that 2%. That's how they're able to keep running. So AIG is that broker. So what AIG did is called a lot of people, convinced them, yo, you qualify for your house, your status is good. So they called average Joe and Jane. It's like, yo, you qualify for a house, you need a house. Average Joe and Jane is working 9 to 5. They cannot afford a bond. But now they get a call, you can afford a house. And what happens when it's payday? People cannot pay now. And you got to understand, it's really connected. It's you who takes out the bond. It's the brokers. It's the lawyers. It's the Federal Reserve. So you got to know there's a lot of transactions that got to take place within that realm. So, and those who can't pay are the one fueling the whole system. So then it collapses. So essentially, that's what happened in a nutshell. Too many houses, people can't pay. Houses lose value. crash happens, people are uncertain now. Of course, there are those few individuals who benefited, but majority, as
But
used to
yeah.
put it since. Yes,
But
sir.
think about this. Think about this. I want to dispute on your point. There's one point that I really my spirit just disagrees with it, and the burden of proof is really on that point of yours. So you spoke about greed. You said the banks started lending money to people who weren't credit worthy. They didn't have good credit scores and etc. So they were risky loans. Let me show you. Let me tell you how a free market works, and I hope everyone's listening. So a free market works like this: in a banking system that is free of regulations, what happens is banks have a risk premium. There's something called risk management. So banks will not give you a loan unless you're credit worthy, unless you have collateral, unless you tick all the boxes. So why was it different in the 2008 crisis? It was different not because of greed, but because of the federal government, the US government, and the Federal Reserve.
Wait. Can I add something before you carry on?
Yeah.
Now, the federal government set a law and decided to lower interest rates. The government did that because they felt like they could prop the economy. The government did that. But Lehman Brothers, is not a government company. It's a private entity. What did the guys do? Because they went bankrupt and they were one of the biggest. Wait, listen. I'll let you carry on. Let me just raise my point to the listeners. Lehman Brothers was one of the biggest firms and it was a personal firm. The government put the law. Lehman Brothers had the right or had the choice to decide, no, we are going to select like this because we want to be in the long run. But you know what they did? They were like, oh yeah, greed is good. And look where greed got them. They were all margin out. They even tried to call UK. They called Warren Buffett to try and bail them out. And guess what? Warren Buffett looked at their balance sheets and looked, wow, we know about Warren Buffett. This is the Mr. Compound Interest. And he looked at the balance sheet and he saw that these people are all out on margin. They are greedy. There's no way they're going to survive this. And I'm not going to put my money in that. Hence, they filed for bankruptcy.
No.
That's my point.
Yes, let me speak. Can you allow me to speak?
Over to you.
Let me tell you. This is what happened. Let me just give you the facts, because what you are explaining is I think we watched the same documentary. I don't know if it was Inside Job or something like that.
Yeah, it's Inside Job. Inside Job. We'll leave the link in the description, guys.
And the people who are explaining these to you is the media. So the media has an incentive to make you believe that capitalism is the reason for the 2008 financial crisis. It's greed. That is not the case. Let me tell you what was the case. The case is, if you look at in the late 90s, government created a lot of policies. You know, everyone always says government should give affordable housing and all these things. They did an Affordable Housing Act. After the dot-com bubble burst in 2001, the government lowered interest rates almost to zero. So they did all these things. So what they did was they established these firms, Fannie and Freddie. So these are government GSEs, whereby they are the ones who buy these loan contracts from the banks. So the bank is the issuer of the loan. So the bank creates a loan contract, and that loan contract is on the bank's balance sheet. It's on the asset. So the banks weren't holding these.
Which are derivatives, guys. But now they were unregulated by the bank, which caused them, when they are unregulated. Listen, wait. I'll sorry to jump into your mouth. I just want to explain the derivatives. So when the derivatives were unregulated, it caused companies like Lehman Brothers to be able to make a deal on how to sell people mortgages. Okay. Over to you. I'm not going to disturb.
Yes. Okay, derivatives is something else. It's another piece of it. But with these loan contracts were bought by Fannie and Freddie. These are government agencies that guarantee loans. So this means that now if the government is buying these loan contracts, it means that the bank doesn't have to bear the risk of the loan. So the bank can just issue as much loans as it wants to anyone. So the government said that banks, you don't have to look at people's credit scores. I will buy the loan. I, as Freddie and Fannie, we will buy the loan and then we will bear the risk. So the government decided to take that risk of defaulting of these loans. So the government removed the risk factor, risk management in the banking sector, because this thing has never happened until the 2000s, when the government interfered in the free market and started to create affordable housing so that everyone can get a house. If you want everyone to get a house, you're obviously going to guarantee the loans. So the government guaranteed these loans by buying these loans from the banks. So effectively, when these people pay back these loans, it's guaranteed by the government. It's just like a student loan that's guaranteed by the government, like NSFAS in South Africa. That's exactly the same thing. And I'll explain why it's detrimental. So because the government removed the risk out of these loans, banks were forced, by virtue, they were incentivized by the government to give people risky loans. So the issuance of risky loans is not because of private sector greed, but it's because the banks told them to, the government agencies told these banks that, hey, give everyone a loan, give anyone a loan, because we want more people to have houses. This obviously drives the price of houses, and then obviously when people can't default on their loans, the whole thing crashes. And the thing that made other banks fail was the derivatives. That's what made banks fail, the derivatives, because these people were buying the derivatives, and when the loans default, the derivative also fails, and then you find insurance brokers like AIG on the hook. You see, you find them on the hook, and then now they are going bankrupt. Lehman Brothers went bankrupt, not because of greed, but because the government incentivized them to issue a loan to anyone, to literally anyone. That's why the loans was a result of government interference. Without government interference, there wouldn't be any housing bust. I hope that makes it clear.
Cool. Listen. Cool.
Yeah.
I get your point. I hope the listeners heard it. My argument still stands. Companies like Lehman Brothers, they had a choice not to participate. But they had a choice.
It wasn't a choice.
What did they do?
It was an act. It was an amendment.
No, the government put the law. They had a choice to say no.
No, but if they don't put the law, if they don't follow, what happens is it's like a regulation, Sia. It's like when government says the banks must have a certain amount of reserves with the Federal Reserve Bank of whatever. So you see, these laws, it coerces banks to give out these loans. It was a forceful law. You had to give. If you this thing, it's basically like government says, hey, these politicians say, hey guys, more people need homes. So it's a good idea. Everyone loves this idea. But when you put these brilliant ideas from government into practice, they end up not working. And when they don't work, people like you, Sia, blame it on capitalism. Whereas they were forced into giving them these loans. And obviously, you wouldn't say no to that. Obviously, so you had to find a creative way to make more money, because banks are not dumb. They knew that these people were going to default. They're not dumb. They knew. So how did they make money from it? They created derivatives. That was their way of making a profit from government forcing them to do all these things. So if the government didn't force them to do all of these things, there wouldn't be a housing bubble. If government just kept their mouth shut and just sat on the sideline and did nothing, because that's what good government is supposed to do. It's supposed to do nothing. Because that's what capitalism is about. The more government does, the more closer we get to socialism. And these have unintended consequences. And when these unintended consequences happen, we tend to blame capitalism, but then we don't see the root of the problem. That's what I'm saying.
I totally agree with you on that point. Those are facts spoken. I cannot dispute. Those are facts. Government interventions, they do have problems.
Think about it. Yeah, just like something that we wanted to talk about, which was the 2020 is it 29 crash. And this is also a classic example, guys. This is a classic example. Crash. You see, it is a very classic example of government interfering with the free market.
Okay, wait.
Yeah.
When we're gonna dive into this, would you agree, before we spit our facts, that greed was also a part of 1929?
Yeah, the greed with derivatives for sure, not with issuing the loans. Yes, I agree.
Okay.
Yes.
What do you listeners think? Please, maybe you can untangle this dispute between me and my host. Please share your thoughts in the comment section below. Don't be shy. Share your thoughts. We'd like to hear your thoughts.
And this is a classic example. 2008 was a very classic example. In fact, the biggest classic example was 1929, October 1929 crash. Because I did history in grade 11. I don't know how many years was that, like 3 years ago. I did history, and they explained to us that the reasons behind this Wall Street crash was greed, it was overconfidence, all these things that people like to hear. But then when you check the empirical evidence, it doesn't match. Because I'll just give you guys a timeline. Because in 1920, after the First World War, after World War I ended, what happened was American soldiers came back, but then it created a recession, because now there's so many soldiers who need jobs and no one is giving them jobs. So recession happens. Do you know what the government did? Something that is very unpopular with economists here. What did government do in that recession? They didn't lower interest rates. The government did absolutely nothing. They raised interest rates. Would you ever expect a government to raise interest rates in a recession? To literally kill the economy in a recession. That's what the government did, and it worked. Here's the nice thing about it. Following 1921, after the interest rate hike, the economy improved, and it created this 1920s, roaring 20s boom, the golden age, whatever you want to call it. And then what we see in 1925 is government interfering in the free market and lowering interest rates and expanding credit to assets like the stock market. So that's what created the bubble. When government forces banks to give credit in the stock market and real estate. That way you are pumping up asset prices. You see, you know what it is. It's leverage. We all know leverage. For those who are forex traders, yes, that's exactly what it is. Leverage. They extended leverage. And the funny thing is, after the extended leverage, the stock market started pushing up. You see, the stock market started hitting all-time highs. Dow Jones, I think it hit, I'm not sure the numbers. I don't even know the numbers, inflation adjusted, so I won't confuse you with the numbers. But the market was in a bubble because of this. And then when the bubble crashed, it didn't create a depression. It was a recession. When the bubble crashed in October 1929, that was a recession. But what made a depression was the government intervention. Because in October 1929, unemployment went to 9%. It didn't even hit double digits. And then the following 6 months into June 1930, the unemployment rate fell to 6.3. So why did unemployment fall? It's because the free market was recovering on its own, like it should. Then what happened after the unemployment went to 6.3 in June 1930? The government came in. Hoover came in, followed by Roosevelt. They came in with these programs to feed people, to give people homes. And when they did that, when Hoover interfered, that's when unemployment hit double digits. That's the irony of it all. And for the whole of the 1930s, the whole decade, unemployment has been at double digits. The whole decade. It didn't even move despite government interventions. Do you know what? Yeah.
I've been thinking to myself, sorry.
Yeah.
Come to think of it, is there a way that the government can never ever interfere? Because I feel it's near impossible. I feel like the system was designed that the government has to interfere at some points in the economy, because it's the government who writes these policies and they pass them into law. Yeah. And then they act upon them maybe after every 5 years when you elect a new president, or they review them some years. But every recession, if we can look at it, it's been stimulus checks. It's been stimulus checks. It's been like that's the solution to our fucking problems when the market, so we are going into some recession. Stimulus checks, give the people free money. Would you still call it free market? Is it still capitalism? giving people money? Is it still capitalism? Because that to me sounds like communism, my friend. Capitalism to me by definition is waking up and fending for yourself. Now, if you ought to wait and for the government to give you something, that sounds like communism to me. Because now the government is trying to inflict some sort of equality within the people.
Yeah. You have a point there, because it's not capitalism. And thingy, the problem is when you look at these government interventions and you think that they solve these problems, and people still love the idea of government intervening. Let me tell you something. Here's the irony of 2020. In fact, before this 2020 thing, you know what took the US out of the depression? It wasn't Roosevelt's policies. It was World War II, because we were still in a recession in the late 1930s until World War II forced people to go to war, which meant that unemployment went down because people weren't in the country, they were fighting war. So that's what ended the depression. That's the funny thing of it all. It wasn't government intervention. And here's the irony of it all. 2020, the pandemic hit. Of course, sickness came in. You can argue whether lockdown was good for the economy or not, but the government is the one who killed the economy. It wasn't the people. The government killed the economy by locking down the economy. Whether it was a good thing on a health standpoint, that's another argument that I don't want to get into, because many people will chop my head off for it.
And we could argue with countries like Zimbabwe, Venezuela. We could argue it's the government who inflicts this upon themselves.
Exactly.
I mean, come to think of it, we were just talking the other day, remember, about Lesego Kganyaka. He's the chairperson for SARB, right? South African Reserve Bank. And he was talking about inflation the other time. And as a listener, let's just ask you a question right here. Are you for inflation or for deflation? Inflation or deflation? Which one do you think is better to fuel a better economy? Now, Tumis and I, we're going to share our thoughts.
Yeah.
I hope you've decided inflation or deflation. So, Tumis and I will tell you that, my friend, deflation is good.
Deflation
because people will always value a lower price. Now, I'll make an example with cigarette smokers. That 1 rand, 2 rand for sin tax or alcohol drinkers, you see that 10 rand or 2, to them it makes a huge difference. It might make them change brands because they feel like they're getting ripped off. So we do feel like deflation could increase consumer productivity. Now, we've seen the unintended consequences of inflation. Look at Zimbabwe.
Venezuela.
Everyone was fucking millionaires, billionaires in Zimbabwe. You fucking buy bread for R1 million. R1 million to buy bread. I mean, come on. It could sound like a joke, but it was actually harsh reality. Which shows us that government needs to know what it's doing in the free market. I mean, yes, the economy is globalized. But I don't feel that it's globalized. I feel that it's monopolized, because if you check, most of the assets in the world are tied to the strongest world economy, which is the United States, the dollar. So, is it still free market when everything is quoted based on how good or bad the dollar is doing?
It's crazy. It's crazy, man. It's literally crazy, because government thinks, you know what the government thinks? The government thinks that they know all the answers, and we're just too dumb enough to figure out how to live our lives for ourselves, how to have a free market. Dude, if you think about it, look at countries with a lot of deflation. I can't believe the reserve chairman said that deflation can be worse because it delays people from buying something. That is nonsense. People love lower prices. How can you say that people don't love lower prices? You see, economic people are so... There's no...
We can make an example. Yeah.
There's no common sense.
We can make you can make an example with this. I'm not getting political with this. So in South Africa, usually around November, we've got Black Friday. where there's these hot deals, so they say. If you do the math, you'll realize nothing has changed. But anyways, that's for the consumer to decide.
Hey.
So we usually have Black Fridays, and there's usually deals: buy one get one free, buy three get one extra, or buy three for this certain price. You know, they play around with the numbers and the type of deals. So usually in South Africa, this gets consumers buying because they're looking at the festive season. And the prices, to say, with food, what I've noticed with food, they do go down. But with clothing on the other side, it's not really like that. So you come to see the behavior that is inflicted upon people.
True.
That's lower things, people are there to splurge. Now let me make another example. You can go to Sensen Mall, and you can go that side by Louis V, and you'll realize there isn't a lot of people there. Because you know why? Louis V never has sales, and it's expensive. Not everyone can afford it. But on the other hand, you can go to Mr. Price, Refinery. You'll always find people there buying clothes because the prices are guys, you guys got the word. The prices are good for them.
Lower prices, man. Lower prices are good. We just have to, you see, guys, as humans, we have to question everything the government tells us. We have to question everything the government does. We can't just sit on our laps and just be zombies and just be brainwashed into believing everything. We have to put everything to an empirical test. And empirical tests never lie. So with that being said, I think I can conclude from that. I don't think I have anything else to say. It was really powerful. It was really blessed. Yes, yeah. Do you have anything that you want to add?
Nah, I just hope to the listeners you guys enjoyed our episode. Basically, this is our style of sharing information with you guys.
Yeah.
As I said, we are always on a learning curve. You can share anything with us. We are willing to share what we know. And that was episode 1 of the World Show.
Yeah.
From Lisia Bongachuma, I hope I'll be seeing you on episode 2. Have a great one.
Have a great one, guys. Thank you, guys. And be sure to listen to episode 2. And we wish you a great weekend or great week ahead, I might say.